108 tops, or within the European Union's borders.
Like the way a local taxi driver would, it terrifies the passenger.
Look at where that stability comes from. And this is highly achievable because of the EREV models starting in 2020. Geo-fenced, perfectly mapped, controlled test track.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
On March 9th, 2026, shares of XPeng surged 6% to trade at approximately $18.45. And if we look closely, the volume and the options data underlying this move, well, they tell a very specific, fascinating story. Right now, the put-to-call ratio stands at 0.525. For those tracking the options chain, that means we're seeing roughly 2 bullish calls for every single bearish put. The market is leaning heavily optimistic. At the same time, we're tracking a massive institutional volume rotation. Over the last filing period, 126 institutions actively added to their holdings, while 146 decreased theirs. That is a heavy rotation of smart money trying to position itself around one core question.
Right, and that core question is really whether we're witnessing a genuine structural bifurcation of the company.
Exactly. Is XPeng successfully pivoting away from being a highly vulnerable, capital-intensive electric vehicle manufacturer and, transforming into a highly profitable physical AI and software licensing architect? Or, on the flip side, is the current market valuation trading roughly 30 to 33% below its discounted cash flow fair value of between $25.95 and $28.16? Is that actually a perfectly warranted reflection of severe execution risks, sustained cash burn, and these looming domestic price wars? My position today is that XPeng's end-to-end VLA 2.0 autonomous driving model, combined with a strategic technology licensing with Volkswagen, signifies a fundamental, highly profitable shift in its entire business model.
Yeah, and I come at it from a very different way. I argue that treating a heavy metal automaker like a pure software as a service company is frankly a dangerous illusion, particularly when you factor in their heavy dependencies on external partners, the highly unproven nature of consumer adoption for AI driving, and the severe macroeconomic headwinds we're seeing globally.
Let's unpack the foundation of this shift, because I think the market is finally waking up to the math here. If you look at the fundamental metrics, XPeng has definitively purged the speculative hype of the early 2020s. We can see this clearly in their forward price-to-sales ratio. It has dropped all the way down to 1.4 times. Compare that to a 5-year average of over 598 times. The froth is completely gone, and what is left is a highly potent technological moat.
A technological moat? Sure, but a financial one?
Absolutely a financial one, and it's driven by the tech. That moat is the VLA 2.0 system. Let's take a second to explain why this is different. This is an end-to-end neural network. It completely bypasses those traditional modular, rule-based software layers. Instead of engineers writing millions of lines of if-then code, if you see a stop sign, then apply the brakes, the system generates driving commands directly from visual inputs, much like a human brain processes eyesight. By doing this, the system is achieving a verifiable 23% efficiency gain in traffic flow handling.
The software architecture is impressive. I won't deny that. But the processing power required to run an end-to-end visual network in real time is immense.
It is immense, and that is exactly where their hardware advantage comes into play. It is staggering, really. While standard autonomous models out there right now are running on dual NVIDIA Drive Orin chips, which deliver about 508 tops, or tera operations per second, XPeng's Ultra variants are equipped with their proprietary Turing AI chip. That single move scales their computing performance up to 2,250 tops. It is essentially the difference between a dial-up modem and a fiber optic connection in terms of how fast the car can think. And this isn't just an engineering flex. It is the financial inflection point we were looking for. We saw their Q3 2025 gross margin cross 20.1%. That wasn't just from selling cars. That was heavily driven by an incredible 74.6% margin on the technical services they are now providing to Volkswagen.
That is a compelling argument. But have you considered the physical realities underlying those numbers? I acknowledge the impressive engineering. The Turing chip's 2,250 TOPS is objectively remarkable hardware. But I fundamentally challenge the narrative that XPeng deserves this AI premium valuation. At the end of the day, XPeng still has to build, stamp, assemble, and sell physical cars in a brutal, hyper-competitive Chinese market. You can't just download a new chassis over the air. They're trying to get Apple-level software margins, but they are still stuck dealing with heavy metal hardware realities.
But that is exactly why the Volkswagen technical services revenue is so vital. It abstracts them from the metal.
Only temporarily, and at great risk. Let's talk about the Huawei risk. XPeng is intensely dependent on Volkswagen as its inaugural commercial customer for this VLA 2.0 system. From a business perspective, that is a massive single point of failure. If Volkswagen develops its own internal software, which, let's be honest, they are highly incentivized to do, and they terminate this partnership after 2027, XPeng's high-margin revenue pillar instantly collapses. They are training their own eventual competitor.
I see why you think that.
And let me just add one more point on the hardware reality before we move on. Look at the reality of their extended range electric vehicle, or EREV, pivot. XPeng's reliance on the new P7 Plus EREV, which literally pairs an electric battery with a 1.5-liter turbocharged combustion engine, proves that old-fashioned range anxiety still dictates the consumer market. By leaning back into internal combustion engines, XPeng remains beholden to traditional, capital-intensive auto manufacturing economics, rather than the pure infinite software scalability you're outlining.
That's an interesting point, though I would frame it differently. They aren't retreating to legacy economics. They are meeting the consumer where they are in order to fund the software future. Let me give you a different perspective on how the software and hardware are merging here. Let's look at the VLA 2.0 demonstration that just happened in Guangzhou in early March. We are talking about geo-fenced, perfectly mapped, controlled test tracks anymore.
Now, Guangzhou is notoriously chaotic.
Exactly. We are talking about unprotected U-turns, multi-lane roundabouts, and narrow suburban streets where traditional mapping data completely fails. The system navigates this with a fluidity that proves their AI is successfully mimicking human cognition. It isn't just following a digital rail. It's making complex spatial judgments in real time. And because of this specific breakthrough, XPeng's robotaxi fleet has officially entered supervised public road testing. This is a monumental catalyst. It elevates them from just being a car company, putting them in direct competition with specialized autonomous firms like Waymo and Baidu's Apollo Go.
But Waymo and Baidu don't have to manufacture hundreds of thousands of consumer cars a year to keep the lights on.
True. But here is the critical difference, and it is XPeng's massive advantage. They have a vertically integrated manufacturing base. Waymo has to buy cars from Jaguar or Geely and retrofit them with $500,000 of sensor pods. XPeng doesn't have to retrofit a fleet. They build the fleet natively around their own Turing chip. They control the chassis, the sensors, the chip, and the neural network. That seamless integration is what validates the physical AI pivot.
I'm sorry, but I just don't buy that. Let me tell you why. The technological capability to perform an unprotected U-turn in Guangzhou is one thing. Widespread consumer adoption is an entirely different beast. Morgan Stanley noted exactly this in their recent analysis. The severe risk here is psychological, not just technical.
Psychological? How so?
The very human-like control that XPeng's engineers are celebrating can actually be deeply unsettling to everyday users. When humans get into a robotaxi, they generally expect machines to behave predictably like machines. They want overly cautious robotic movements. If the car is aggressively taking an unprotected U-turn by inching into ongoing traffic the way a local taxi driver would, it terrifies the passenger. And when you're running robotaxi trials in complex urban environments, the margin for error is absolute zero. Just one high-profile accident during these public trials, one momentary lapse in that 2,250 TOPS processor would completely evaporate the software-led valuation premium you're pointing to. The market is pricing in a flawless rollout, but real-world edge cases rarely allow for flawless execution.
I hear you, but the market isn't pricing in perfection. It is beginning to price in structural financial stability, driven by the strategic licensing we touched on. Let's look at the break-even timeline because the math is starting to heavily favor XPeng. Goldman Sachs is projecting a full-year 2026 break-even, targeting 2.2 billion yuan in GAAP net income.
Projections are just projections.
Fair, but look at where that stability comes from. It comes directly from the expanded Volkswagen alliance. And I need to clarify what this partnership actually is, because it's not just about throwing some XPeng software onto a dashboard screen and a few EVs. XPeng is deploying their China Electronic Architecture, the CEA, into Volkswagen's entire ecosystem. Let me break down what this zonal architecture actually means. Think of a legacy car's electronics like an incredibly messy office. You have 50 different mini-computers or electronic control units running different parts of the car. One for the windows, one for the brakes, one for the AC. It's heavy, expensive, and a nightmare to update. XPeng's zonal setup centralizes everything into a few master hubs. This is going to reduce Volkswagen's electronic control units by approximately 30% across their locally produced internal combustion and hybrid models starting in 2027.
Which is a massive cost saver for Volkswagen.
Exactly. XPeng is getting paid a premium margin to fundamentally streamline a legacy automaker's production costs. This effectively decouples a significant portion of XPeng's revenue from the volatile month-to-month unit economics of having to sell their own cars.
If we are going to look at the 2026 projections, we have to look at the cost side of the ledger. The break-even timeline is far more fragile than Goldman Sachs' optimal scenario suggests. You mentioned the Turing chip and the computing power required to run the CEA. We need to highlight the intense R&D cash burn required to stay ahead in this AI arms race. Developing silicon and training neural networks is astonishingly expensive. If XPeng misses those Q4 2026 profitability targets, the threat of shareholder dilution becomes very, very real. They will have to raise capital.
They have a healthy cash buffer right now, though.
For now. But furthermore, you simply cannot decouple an automaker from the physical supply chain, no matter how good their software is. Bank of America recently issued a severe warning regarding raw material volatility that directly threatens XPeng. We're looking at potential pricing spikes for high-bandwidth memory chips, which, by the way, are absolutely critical for these high-TOS AI systems to function. You can't run VLA 2.0 without state-of-the-art memory. Add to that the fluctuating costs of batteries and critical metals. If those input costs surge over the next 12 months, they could completely destroy the projected 23% gross margin anticipated for late 2026. The high-margin software story is incredibly vulnerable to low-margin hardware realities.
I'm not convinced by that line of reasoning because you're ignoring the scale. The volume scaling provides a natural buffer against those supply chain pressures. XPeng has set a 2026 delivery target of 550,000 to 600,000 units. That represents massive growth, somewhere between 28 and 40% year over year. And this is highly achievable because of their dual-pronged product approach.
Achieving 40% growth in this economy is a tall order.
It is, but look at the lineup. You have the Mona M03 acting as the absolute mass market pillar, dominating the 100,000 to 200,000 yuan segment. And then you have the dual power P7 Plus ERV we discussed earlier. You mentioned the combustion engine as a weakness, a sign of range anxiety, but strategically, the management data shows the ERV variants are generating 3 times higher orders than their pure battery counterparts. It's meeting the consumer exactly where they are, alleviating the charging anxiety while getting them into the XPeng software ecosystem. If they achieve the upper end of that 600,000 delivery guidance, an expansion of the price-to-sales ratio toward 2.0 times naturally drives the stock right into the $34 to $36 analyst targets set by firms like Morgan Stanley. The scale entirely justifies the valuation.
Scaling to 600,000 units relies on a massive shift in consumer confidence that the macroeconomic data simply doesn't support right now. Let's look at the broader picture. The 2026 Chinese GDP growth target is set at 4.5 to 5.0%. That is a clear, undeniable signal from the government that the era of hypergrowth is over.
You cannot safely mod a 40% vehicle delivery growth in a domestic market where the middle class is deeply cautious with their discretionary spending. People aren't rushing out to buy experimental tech when they're worried about their savings and the real estate market.
Which is why international expansion is such a key part of the thesis.
But if you look toward international expansion to absorb that excess volume, you hit a massive geopolitical wall. We have an ongoing bitter trade dispute between Brussels and Beijing. This has resulted in a 30.7% total levy on Chinese-made automotive exports into Europe. That tariff structure is a major structural threat to their margins abroad. You can't just scale your way out of a 30% structural tax. Every car they land in Europe is already fighting with one hand tied behind its back.
I agree. The tariffs are punishing, but they are already outmaneuvering that structural tax. XPeng isn't just sitting still and absorbing the 30% hit. They are actively hedging the geopolitical risk by partnering with Magnus Steyr to assemble vehicles locally in Austria.
A complex logistical undertaking.
It is, but by establishing local European assembly, they effectively bypass those import tariffs entirely. The vehicles are produced within the European Union's borders. It's a proactive, aggressive strategy that protects their international margins and proves management can navigate the macro headwinds.
Assembly in Austria comes with its own elevated labor costs, strict union regulations, and operational overhead. It's not a magic bullet. But setting the European strategy aside for a moment, let's look at where they are choosing to allocate their capital domestically, because this is where the bullish narrative really stretches credibility for me. I'm talking about EREV, their massive foray into the low-altitude economy.
EREV is arguably the ultimate call option on the future of mobility.
Or a massive distraction.
Let me explain why it's not. It demonstrates the absolute breadth of their engineering capabilities. They aren't just drawing concept art. They are currently building a 120,000 square meter intelligent factory in Guangzhou that is capable of producing one flying car every 30 minutes. Let's talk about the land aircraft carrier. It is a modular system featuring a 6-wheeled ground mothership, basically a high-tech van, and a detachable eVTOL aircraft that deploys from the back. They already have 7,000 solid pre-orders for this system. Furthermore, they are the first Chinese company to secure an overseas manned aircraft special flight permit in the UAE. This isn't science fiction, and it isn't a vanity project. They are mass producing it in 2026. It establishes XPeng as the absolute dominant leader in what the government has officially designated a national strategic emerging industry.
I have to admit, the idea of a flying campsite in Hainan sounds like a fantastic weekend getaway. But as an analyst looking at their balance sheet, it is terrifying. It is a 2 million yuan, or roughly $280,000 luxury distraction. Think about the context. When you are fighting a brutal, margin-crushing domestic price war in the automotive sector, and your primary path to survival relies on reaching Goldman's break-even target by Q4 2026, allocating immense engineering and financial resources to EV tools is highly questionable.
It secures future market share in a new sector.
Yes, they are building 40-plus flying campsites on a demonstration island in Hainan. But how does a flying campsite in Hainan solve the immediate cash burn? How does it solve the rising costs of high-bandwidth memory chips? How does it alleviate the intense pressure from legacy automakers undercutting them on price in their core business? It simply doesn't. It is a fascinating, headline-grabbing engineering project that completely obscures the very precarious financial tightrope the core company is walking right now.
We can debate capital allocation, but when we zoom out and look at the totality of the evidence, I maintain that XPeng is fundamentally undervalued at its current price. They are successfully transforming right before our eyes from a traditional, vulnerable manufacturer into a high-margin technology licensor. The sheer 2,250 TOPS hardware moat provided by that Turing chip, combined with the pragmatic, volume-driving global EREV strategy, positions them to capture both immediate market share and those highly coveted long-term AI software multiples.
But I maintain that the structural realities of building physical vehicles cannot simply be hand-waved away by a great software update. The vulnerability to raw material costs, the severe macroeconomic constraints on Chinese consumer spending,
and the extreme reliance on a single major partner in Volkswagen for their software revenue, well, it makes the AI premium highly precarious. The execution risks over the next 12 months are simply too severe to treat these bullish, flawless projections as a baseline certainty.
While our perspectives on the timeline and the financial risk profile diverge significantly, I think there is a clear convergence between us on the engineering reality. The VLA 2.0 architecture and the deployment of the proprietary Turing chip do mark a genuine, verifiable technological breakthrough. They have successfully moved end-to-end neural networks out of the controlled laboratory environment and onto complex, unpredictable, chaotic public streets.
Agreed. The engineering leap from modular, rules-based systems to end-to-end visual processing is profound. Regardless of how the market ultimately values it, or whether they can turn a profit on it in 2026, the technology itself is a massive step forward for the industry.
For anyone following this structural transition closely, the upcoming March 20th, 2026 earnings call is going to be highly illuminating. I highly suggest monitoring the specific ramp-up rate of the technical service revenue line item. Alongside that, look for any guidance provided on the production schedules and yield rates for the Turing chip. Those two metrics will clearly signal whether XPeng is truly Huawei-wizing its business model or if it remains bound by the traditional low-margin automotive cycle. There is a tremendous amount of nuance yet to unfold in this material.
Absolutely. The raw data over the next 2 quarters will definitely clarify which trajectory is actually taking hold.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!